Silver Pros Thursday live stream. Sorry, we had an errant YouTube video playing. 4 p.m. Central Time, May 4th. This is the Thursday edition because we were not available Tuesday. We had a lot going on in the market, so we're doing a live stream today. We're going to talk about a lot today, guys, and this is going to be something, basically the same conversation that I had on Live from the Vault on that YouTube channel last week. I think it came out last Friday, and we're going to be talking about what's going on with gold, what's going on with the banking system, a little bit about what's going on in central bank digital currencies and how you can protect yourself. Thank you, everybody, for joining. The poll is up. It's called, what is your financial escape plan? Gold, silver, cryptos, asset-backed digital currencies like Kinesis or LODE or ARIS or those types of things, or fiat other than the dollar. Would you be investing in euros, or would you be investing in yuan or perhaps pesos somewhere? Those are different financial escape plans. Please enter your choice into the poll, and we will go over that at the end of the video. Thank you, everybody, for joining us in the video and being a part of the show. So what is going on in the world? A lot is going on. The banking system is in serious trouble. And essentially what we're seeing is not good things going on. We're going to start with gold and silver. Let's just do a review of that. Gold has been in a bullish trend since the turn of the century. And you can see it's broken out here on the upper right-hand portion of the chart past its moving averages, its 50 and 200 day, which basically means it's accelerating. The rate of speed at which gold price rises is accelerating the trend, not only this year, so the 50 and 200 day moving average, but also for the last 23 years, dating back to 2000. So now we are firmly in another leg of the bull market. It's basically indisputable at this point when we're looking at the chart. And of course, when you look at gold sales, that is also true. When we're looking at silver, it's a little bit different. We actually got a trend line down in silver dating back to the pandemic. We had high volumes in the pandemic period, smaller volumes here. So the rally is not as strong, although we have broken through resistance, the 52 200 day moving average, the 24.50 resistance. And now we're popping the $26 resistance on the chart. And next one up is going to be something like 28.50, 29 bucks. So we have a nice silver rally, but this rally is not as strong as gold. You see it on the volume, at least on the derivative side or the technical charts. The technical charts look at the derivatives, not the physical trade. We've got two indicators down here talking about the strength of the rally. The MACD is saying in the short term, as of 26 days to now, that month period, silver's a little too hot. It's risen really fast, and that makes sense. It rose through, it popped through a bunch of resistance points. It's probably going to want to range trade a little bit. If you look at the short-term signal, the longer-term signal, the RSI, indicates a medium to long-term view on silver, and it's below the 70 line. So the market still thinks in the medium term, silver has some room to run, and that's given current conditions. That's not talking about whether gold pops and other things happen in the economy. It's given current conditions, the current market, as it's constructed, the market believes that in the short term, silver may come off a little bit and fall down a little bit, which would seem to indicate the trend line, but RSI is indicating that trend line may reverse, at least from the technical chart, which makes a lot of sense. I wanted to look at US bankruptcy filings per year, and we're already up to 111 in 2023. That is the fastest pace through February, through the first 2 months of the year since 2011. That's right, since after the financial crisis. We are having faster bank failures, and we haven't even gotten into the official recession this time, guys. There is no official recession. The government's not declaring a recession. We had 2 consecutive quarters of negative GDP last year, and they didn't declare a recession because they're arguing about employment. Of course, we know that the employment numbers are fugazi. They're a lie. So we don't believe them, but in any case, that's the government stance, and I guess they're sticking with it. You also look at dating back to December, we had a lot of bankruptcy filings, and these are companies. So this isn't banks necessarily. These are companies in the S&P 500 that are crashing down. And so what you see is you see problems occurring in the corporate side of the house as well. And what happens there on the corporate side is their ability to get easy money to finance their operations and their expansion and all of those things is harder. The Fed has been tightening. And so that's not only the Fed tightening, raising rates and causing treasury prices to fall, affecting the banks, but it's also causing problems with corporates who can't refinance their existing debt. because it's higher rates, and corporates had taken on so much debt to begin with. If you remember what happened to corporates since 2010, 2011, they took on a lot of debt, and these corporates spent it on paying off stock and making the rich insiders for the company, the owners of the company and the friends and family rich. Now the corporate fat cats have gotten rich. And the reason the way that they did that was they took the cheap debt from the central bank. They bought back all their shares. And by the way, issued new shares. They kept issuing new shares. So they're just buying back shares to transfer that easy money on the balance sheet from their debt, from their liabilities, debt owed, into the hands of the shareholders through that mechanism, buying shares. And so the fat cats in corporate America got rich. And this is why the last 10 years, we've seen record amounts of sales of insider stock. I talked about this on Seeking Alpha. I must have written 5 articles on it on Seeking Alpha the last 10 years about insider buying of stock. I'm sorry, selling. And there were net sellers dating back to the last financial crisis. So all of the corporate executives are smart. Since the last recession, they've never believed in the recovery themselves, and they're running the damn economy. They run the companies that form our economy, and they were voting to get more debt to pay themselves off and to sell their shares because they didn't believe in the system and they wanted to get theirs. And they've been doing this for 10 years. And that's why we saw all those share buybacks and all that incredible increase of debt across the system. Of course, they also used debt to expand operations, of course, but a lot of that was paying themselves off. It's like skimming off the top. And the way that you do it is you bring that debt in, you convince shareholders, we're going to expand and do all these things. And you talk about it and you take on the debt. And yes, you spend some of that on R&D and you spend some of that on capital expenditure. And capital expenditure is what you spend to increase the overall capabilities of your organization, and some on OPEX. And the OPEX is just everyday ongoing expenses. And then the rest went into share buybacks. And so the insiders sold and the rich people sold all their shares in these companies and they got rich. But that's ending. And so now what happens is the companies have piled up all this debt on their books and they paid themselves all off. They've given themselves their golden parachutes, but now they don't have solvency. They don't have liquidity and they can't go back and refinance at higher rates. All the rates have gone up. At the same time, their asset values on their balance sheet have gone down. The treasury values and things like mortgage-backed securities and things that are affected by the rise in interest rates, that debt, that value is starting to come down and it's affecting their balance sheets. And so now you've got a situation where all the assets that all these companies were focusing on, let's go back to the share screen for a moment and let's emphasize this. Look at all of the failures, okay? All of the failures in corporate America. What was happening was they were taking on debt. And the reason we have these failures now, they took on debt this whole way through, bought shares, insiders sold them off, got rich. Yes, they did expand some of the capabilities, but not enough to justify all the debt they took on. Now they have so much debt and their asset side of the balance sheet is shrinking and they're not able to get that cheap credit. And so now corporations are starting to go bankrupt. It's not just the banks, ladies and gentlemen. Yes, the banks are going bankrupt, but so are corporations. And while we've had 3 major banks fail and a couple other small ones got into trouble and or had to be bought out, a massive, about 25 times that in terms of corporations have gone out of business. And that's not good. Now, what's going to happen is that's circular, because think about some of the assets the banks have on their balance sheet. They have corporate debt held as an asset. What happens when these companies go bankrupt? It puts further pressure on the balance sheets of these banks, and it's causing them to go through extreme pain to the point at which we see the depositors do this. The depositors saw what happened, okay, during the pandemic, and they pulled some money out for cash, okay? It started in the pandemic, the amount of money went up because the Fed printed, and then after the pandemic, as employment's a little bit weak, consumers were stressed. Remember, we've been talking about consumer sales the last couple of years being weak. People pulled money out of the bank, and then when we had the bank failures right here, boom, you see the deposits just going crash. Now, this is the first time that we've seen a massive deposit draw in domestically chartered U.S. banks dating back to the 1970s, ladies and gentlemen. We don't see it on the chart. Because think about it, about this time, what did they do? They took gold, they took the dollar off the gold standard and they started printing money. And the printing money really started happening in the 80s. You had these 2 nasty back-to-back recessions. You had the high interest rate, Paul Volcker raising, interest rates at the Fed. That was in reaction to the free floating dollar not being capped by gold. They got that under control. And then we had nice little steady growth in the money supply. until the last couple of recessions, the tech crisis. You can see the inflection point here, and you can see the mortgage crisis, the inflection point, and then the little self-imposed pandemic shutdown on the economy by governments, and then a massive bazooka. Now, this little tiny recession didn't need a massive bazooka. This massive bazooka of money that eventually led to more deposits, because think about it, the Fed prints money, people are going to have more money, they're going to deposit it, right? Okay, so that's what happened. So companies and people are putting these deposits in because the Fed's printing money. But this massive bazooka of money isn't preventing companies from crashing or banks from crashing. It didn't make consumers solvent. Consumers have more debt than ever. They're tapped out. All it did, that easy money led people to taking on more debt and buying more things they didn't need. And boom, here comes the crash. Here's the banks and the crash down of deposits, and it's eroding the banks. So if you go back to what we're looking at before, you've got corporations crashing, you got people pulling out their money, and the banks are in serious trouble, and that's causing the precious metals to go up. We're having a nice all-time little blip on an all-time high yesterday, you know, on the CFD market, and gold trade at 2081. Good enough to say we had an all-time high, just blipped. It didn't stay there, but nice that on a little bar, you know, on there, we saw it pop 2081. So there's desire for gold to rise, and silver's the little yappy dog, or the little brother to gold. I wouldn't worry about this trend line. We've had a breakout because gold's risen. Silver follows at a higher rate. Now, silver can be very volatile if gold's sideways trade, but as soon as gold continues to go up, silver's going to go with. So I'm not too worried about that. If you're a silver investor, it will come. I wanted to also talk about the solvency of the banking system. This has become a huge issue. This is the KRE, which is the SPDR S&P Regional Banking ETF right here in the US. What is this tracking? It's tracking what? The domestically chartered banks. And it's doing the regional ones, though, the ones that came under trouble. SVB, Signature, First Republic, as you can see, I've graphed those out for you. So this ETF, which is measuring a basket of domestic, regional banks here in the US, really talks to the health of those companies, at least from a share price perspective. What do the shareholders of these companies think of the bank? Are they solvent? Are they buying their shares? Well, you see what happened in March when we had two massive bank failures, the second and third largest bank failures in history. Boom, straight down, limit down, people selling shares, not only of SVB, not only of Signature, but across the regional banking index, to where that index went from, was that high 60s, mid 60s, just above mid 60s. Well, actually it was up here, last year, in the almost the 70s, all the way down to the current print of 36.33. So we've had basically the regional banking ETF has been cut in half, dating back to late last year, cut in half. And most of that fall came after the second and third largest bank failures. And then we've had a big crash down here with First Republic. And that big bank crash, you see, we were sideways trading. The Fed had done all their stuff. They printed the money, they did all the things. And then we had another bank failure. And then bam, what happens? Index crashes again. And look at the volume. This is the volume of selling, okay? People are selling regional bank shares in America like they're going out of style, like they're Beanie Babies and nobody wants them anymore. This isn't the 90s. We don't collect, well, some collectors collect Beanie Babies, but they're not producing those in mass quantity anymore. It was a fad, right? Well, these regional banks were a sort of fad. They're crashing now. They were never going to hold up. They bought into this QE system. They took on all that debt, but they have a higher loan to value ratio than do the big commercial banks, which also do other types of finance, because these regional banks were really lending to businesses and individuals. And now those loans are going bad, and the assets they had, the treasuries, are being devalued, and these banks are crashing because they don't have the size and liquidity of the big commercial banks. So now what happened? JP Morgan comes in and they buy up First Republic, right? They buy them up. The Fed rescues the depositors, SVB and Signature, but lets the investors go bankrupt. Why? Because these guys were involved in digital projects, and the Fed doesn't want and the FDIC, the government, doesn't want these private digital currencies like Bitcoin and Ethereum. They like the fact that Bitcoin, Ethereum developers are developing that product, but they want to grab it and use it for their central bank digital currency. They don't want them to survive. And Signature and SVB had ties into the crypto and the technical space, and therefore their investors were basically bankrupted. And think about what happened to the currency exchange FTX, okay? So you're seeing all this massive dislocation. in the cryptocurrency market, because last year during the sell-off, the cryptocurrency market took it in the shorts. It sold off. Bitcoin sold off. Ethereum, they all sold off. You know, and what happened was all the banks that were involved in those projects followed, and the exchanges followed, and we had that big crash down. And that's essentially what happened. But that contagion wasn't limited to the crypto space. Oh no, that was just a small portion of what's going on. No, First Republic got taken out. And there are two other banks, I think it's PacWest and another one, that were in the news right now. So you're seeing the contagion, the dominoes are falling, bop, 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 down the regional banking. And you can see that in the ETF. The ETF is crashing down. Why? Because the whole system is going straight to hell. And the Fed can't backstop it, and neither can JP Morgan. Okay. That crash down is what has popped gold and silver, and we're up. And as I told Andrew on Live from the Vault on Friday, when that video came out on Friday, you know, we were talking about what the solution is. It's problem solution. What is the solution? Well, the solution this time, ladies and gentlemen, is going to be the central bank digital currencies. They want the central bank digital currencies. Now that system will put into place automatic push button control over the aggregate money supply of the nation. And when you have control of the aggregate money supply, you have control of industry, you have control of people, because you're controlling what they can spend money on. But the bigger thing is that they'll have control over inflation, deflation cycles. And when we have deflation, our labor as stored in silver and gold, hopefully you're storing it in silver and gold, that deflation helps savers because it lowers prices in the economy and raises the value of money, i.e. commodity money, gold and silver, or maybe Bitcoin, if that ever becomes money at some point in the future, the cryptos, so that then the savers get rewarded. That's deflation. But what have we had since the central bank era, dating back to the mid 1800s in Europe and now the early 1900s in the US? The central bank era has been characterized by high inflation. What is inflation? It robs value in the system. It robs your labor. Why? Because you're trading your labor for money that is being devalued, so that inflation is a tax on your labor. It steals your labor. So if you spend, you know, an extra 20 hours this week working at your job, and you sell, you know, you make an extra couple of grand, good for you, you got a good paying job, you got it. That extra grand, if you leave it in the bank, they're slowly stealing it. They're slowly stealing it by inflation and by money printing. They're slowly stealing. They're just taking it out a little bit. Thank you very much. A little bit. Thank you very much. A little bit. And they're dripping you dry. And they're stealing the labor that you spent because you weren't saving in something that retained value. What retains value? Well, ladies and gentlemen, this retains value. Gold retains value. I have a gold coin here. This retains value. The precious metals retain value. Now silver is more volatile, and it hasn't had that nice uptick like gold has on the chart. Let's go back to the charts and let's talk about the difference in how gold and silver react to what we're seeing in the economy. We'll go back to those charts. Gold has had this nice steady increase for over 20 years, and it's had this consolidation period where people came in and said, we're going to sell it off in the derivatives complex, but everybody came in, nope, we need it. The central banks bought during this whole time. The public got involved. People got involved, and you had this nice steady growth. Now there was a dip and a recovery, but if you graph it, it's a nice steady growth, right? A little bit of a choppy chart, but we got there. And now you've got a breakout. And gold it'll have its ups and downs, but they're really long. They form over a long period. This is a 10-year chart between 11 and 21, between the previous all-time high in gold and the next all-time high in gold, or about 9.5-year chart, if you will. I think it was September, was it 2011 when gold peaked? And then this was late, was it October 2020? You know, right after the pandemic when gold hit its new all-time high. And then of course we can say it hit another one right here. And you can see the periods between gold hitting higher highs, which is how you know you have a bull market. Higher lows and higher highs. Low, higher, low, higher, low, higher. Now this one went lower, but it recovered. Higher low, higher low, higher high, higher high, higher high, higher high, higher high. Okay. That's how you know you're in a long-term bull market. And that's what happens to gold when you're at the end of a 50-year fiat cycle in which the system has stolen so much of your labor and your value over time that you don't have it. And it goes to someone else. And you become individually financially solvent unless you invested in gold and silver and stuck with it even during the down period, because we knew the money printing didn't stop here. The bankruptcies didn't stop here. None of it stopped, okay? This is all Fugazi. This is fake. It wasn't real. This is not real. It's bullshit. And we're the channel of no bullshit. We're Cowboy Males Live. And this is bullshit. It was a fake signal, but look at the trend. Now what happens to silver? Silver's a different animal. This is a shorter term chart, by the way. It's only a couple of years. But if you look at the long-term chart in silver, it's been schizophrenic, like this, because it's been industrialized, and silver acts differently. During times of normal economic growth, silver becomes a commodity metal, and the derivative markets trade it as a commodity. So it's up and down based upon individual supply and demand dynamics of the physical metal and how that's manifested in paper on the derivatives between the miners and the merchants and the bullion banks who are doing all this trade. And so it's much more like a commodity chart. And people are like, oh, silver's not an investment. I'm out of that. Forget silver. But it is, because what's happening now, this pop right here, and during silver squeeze, bam, right here, those pops in silver squeeze, this is money demand. Silver squeeze was monetary demand, and the bank failures creates monetary demand. And when monetary demand comes into silver, boy, it gets up and it boom. And when gold goes up to new all-time highs, silver tends to follow. It lags behind. Gold is retesting its all-time high of like 2070, 2080. It's weird because the candle on the chart, depending on what chart you look at, it's somewhere between 2069 and 2079, the all-time high, and it's a blip. Before on gold, it blipped on it again recently. So that's a sign. If it blips firmly through 2070 and ends a week above 2070, I'm going to call a new all-time high, maybe 2074 if we're being generous. And then that's going to be our signal that pretty soon silver is going to follow. Sometimes it takes a few weeks, sometimes a few months. But every time gold hits a new all-time high, silver goes boom. And that's why silver is trading over 26 today, because gold touched on an all-time high. Now, I don't think silver is going to rise 27, 28 right away unless gold punches through its all-time high. Then you're going to see silver pop 30 and get to 30. Why? Because that's what we saw during silver squeeze. Silver will pop 30 when gold hits a new all-time high. At least it's going to march there. Now, we'll have to see what happens to derivative markets. Will the CFTC step in? They tamped it down last time. Are they going to tamp it down again this time? They may have to. Why? Silver is what? An industrial commodity. That's what the chart tells you. And when the monetary demand comes in, the people that regulate the commodities market tamp it down. Why? Because they see it as a commodity, and they're trying to keep that silver from being unobtainium, like Mike Maloney says, and going limit up. Like, remember on the LME market when nickel went limit up and no price would get you nickel? Because silver will do that when there's more demand than supply. When the money comes in, okay? When the money comes in, it's going to pop silver. But the market doesn't see silver as money. The CFTC commissioner doesn't see it. The Fed doesn't see it. The U.S. government has, since 1965, has not seen silver as money because it wasn't in the money. It's not been money. And just because they do American silver, this is a maple leaf, but because the Americans do silver, American silver eagles, their version of the coin, they don't see silver as money. They're just doing it because that's their remit. Okay, the Fed doesn't look at the mint, and nobody looks at, the government doesn't look at the mint. The congressmen don't look at the mint and say, oh, silver's money. We need to make that. No. They're all wrapped up in this dollar system since 1913. It's all they grew up in. It's all school has taught them. It's all they know. So silver won't pop until that monetary demand comes in. And that's when it pops. We saw it during silver squeeze. We're seeing it again during the bank runs. And that's what's going to happen. And that's essentially where that market is going. Now on to the new system. Regional banks are going to fail. I think a lot of them are going to be bought out. First Republic, I think mostly was bought out by JPM, except for certain assets. I think the FDIC put in 13 billion, some other things. But JP Morgan essentially absorbed them. They absorbed Washington Mutual, the previous all-time biggest banking failure, which I think occurred during the last crisis, if I recall my notes. So JP Morgan's taken on the two biggest bank failures, recent bank failures in US history, and biggest overall. And so you're going to see more of that. JP Morgan can't do them all. So as these other ones start crashing, the Fed and the government's going to go beg some of these other massive worldwide banks to take on the American regional banks. And what you're seeing is an uptake of what? American money into what? International commercial banks. What does that do for the American dollar? It takes it out of the hand of America and it gives it to the international banks. What does that do? It allows them to exchange it for other currencies. That's going to have a little bit of a draw on the dollar, but they're also eliminating the dollar. because the banks that use the dollar exclusively, the regional ones in the US, are going out of business. And the multinational banks deal in all currencies. So it's de-emphasizing the dollar in the commercial banking system, you see? And that allows the consolidation of the commercial banks, the uptake of the regional banks, the sucking up of the cash in society is what's going to lead to the next system. When the crash comes, they're going to go to some form of digital dollar. Now, on my channel, I said FedNow. The Fed is saying that FedNow is not blockchain. But when I look at the fee schedule and the setup of FedNow and how many transactions are going to have to handle, it looks suspiciously like a blockchain to me. So I think FedNow is based on blockchain technology because I know of no other technology that could handle that transaction volume with that low of a fee schedule other than blockchain. At least it ain't public. Okay. So I think the Fed has created their central bank digital currency. I think it's coming out in June and July, as they've said. I think their announcement said sometime early summer. Wherever that is, I don't care. And they're going to be testing it. Now, I've also got intel from people that go to the BIS website every day and have been researching this, that they have been testing this in different regions, payments across regions, across the rail system, the connector of all these regional central bank digital currencies, and it's starting to work. So now we know that they've started trading the central bank digital currencies and it's working. Okay. So once they have confidence that system is working, they can let the dollar go. They don't care anymore. Okay. They're not going to care anymore. Now, what is the repercussions from all of this? Okay. Well, one thing I'm going to talk about past repercussions, and then I'm going to talk about the future. So when I talked to Andrew on Live from the Vault, we were talking about why the big banking system exists and why currencies. When you have a dominant world currency like that, the US can export their dollars to other countries. It's exporting inflation. Those countries have to deal with inflation, right? And it kind of wrecks their economy because they don't have their own, individual sovereign currency that's allowed to be like a reserve currency like the dollar. That's saved for the dollar. So everybody they have to exchange their currency for the dollar, bids up the dollar, exports inflation. Well, now all those dollars in foreign bank accounts are starting to come back. Why? People are de-dollarizing. People are doing contracts outside the dollar. So we'll start to see some of that come back, and that could lead to hyperinflation. The ultimate destruction of the dollar is when nobody wants a dollar anymore. When you don't want the dollar anymore, confidence in the dollar fails, and then it goes back to its intrinsic value, which is about 6 or 7 cents. That's the cost of the linen and the ink and the printing of the dollar. I think somewhere in that range. That's going to be its intrinsic value. Or some people may hold them as collector's items. I mean, I bought an old silver certificate that was $1 on it, and it cost me like, I don't know, $10 at the coin store just to have it. So it may become a collector's item, much like pre-1933 gold. Pre-2000, whenever the dollar crashed, let's say 2024, just hypothetically, I'm not saying that's what's going to happen, but hypothetically, if the current version of the dollar officially dies 2024, 2025, those will become collector's items in the next 10 to 20, 30 years because it's signaling the end of an era, right? And then we're going into the digital era, okay? And what happens in the digital era is now you give control to the central banks to control aggregate money flows and to control the value of your labor. When they control a currency like that and they can push button it, not only can they regulate your behavior through a credit system, but more importantly, and I think what's coming down the pike is they control the value of your labor. Because by instituting changes in the money supply, they can steal your labor. It's a harvesting system to steal labor and commodities cheaply. That's why it's done. So the nations with the dominant currency, whether it be Rome or whether it be Spain at that time, or the Assyrians or the US or the British, all nation states, Chinese even, all nation states have done this across time. They use the same, it's the neo-mercantilist system. And this is what I told Andrew. You create the money, you export inflation, you get commodities cheap, okay, you live it up, and then you export that inflation. Eventually, the commodity producing nations get strong enough and they get tired of it and they start banding together, i.e. the BRICS nations and the Belt and Road Initiative and the Zimbabwe asset-backed digital currency, gold-backed digital currency, and the Russian and Russian and Chinese, is it gold-backed and Zimbabwe gold-backed currency? You're starting to see gold-backed currency, an asset-backed digital currency pop up. Their digital currency is backed by assets. And that's outside where? The West. So lots of countries in the West want the central bank digital currencies. I think some of the other countries do as well, but they're protecting themselves by the issuance of separate asset-backed digital currencies so that within their own trading blocks, they have stability. They're only going to use the central bank digital currencies for international trade because that's the way the system's going. But China, Russia, Iran, Zimbabwe, all those countries and those trading blocks, those friendly trading blocks, are issuing asset-backed or gold-backed digital currencies, which is going to preserve the value of their internal currency. So when you look at the new system, the other thing that's coming out is there's two levels of currency: wholesale currency, which is international currency, and then retail currencies, which is what the people get. Okay, and that's the internal economy. So what's going to happen is, yes, the international currencies, whether they be digital or paper, are going to trade in a basket against each other. But now you have a two-tier system, and this is promulgated by the BIS, and countries are following it, where you have your own internal currency. Those are controllable by the nation state, not affected by international trade. That brings some stability to the system. I see the benefit of that. But it also means that the internationals will control the value of your currency. And unless you're in a place where you have an asset-backed digital currency, like the Zimbabwe and some of the others, you're going to be in trouble. And in the US, they're not talking about asset-backed digital currencies. The Fed doesn't even acknowledge gold. They're going straight centralized digital currency, and that's what's going to happen. And it's going to pop gold and silver. All right, getting back to the poll, what is your financial escape plan? Nice to read this after we give the presentation. It really hadn't changed much. 93% say gold and silver. I'm Gold Silver Pros, is a Gold Silver channel, no surprise. But we have a lot of people that watch us that do cryptos, that invest in Forex and things like that. We've got 3% cryptos, 1% asset-backed digital currencies like a Kinesis or a Load or an RS or that type of thing. And then we have fiat 2%. So some people are playing it in other, physical currencies. We're going to go ahead and end that poll. Thank you guys for voting in that poll. This, to reset and to summarize, has been gold shocks the world as the safe U.S. banking system is in a free fall collapse that has attributes that are worse than at any point in U.S. history. Let's go back to that. Let's go to that chart, ladies and gentlemen. Okay, dating back to 2011 and 2010, we had the last big financial crisis. We've had more bank failures in the first 2 months. And the velocity is on an uptick here, dating back to December. Okay, and you had some during the pandemic, 71, 73 here, but this is the biggest since the pandemic, and it's 3 months in a row. And we ain't stopping because what stopped the pandemic, I'm sorry, these are corporate failings. What stopped the corporate failings, during the pandemic was restarting the economy. The things underlying the corporate failures now haven't changed. This is going to keep going straight off to the edge of the chart, ladies and gentlemen, and ain't going to stop. And if you look at the banks, you look at the banking index, sorry, getting back to the banks specifically, they're crashing down, okay? They're crashing down. And so to summarize, what's happening is the deposits are being removed. People are taking money out of the system in a panic because they need liquidity because they know the stuff's coming. That's causing problems in the banks. The bankruptcy filing by corporates is going to cause problems in the banks. This index, as a result, is going to crash. Consumers and corporates are going to crash the banking index. Can't be stopped. I don't care. There's not enough money in the FDIC, and the Fed can't print enough money to stop this, because they're at the point of no return where if they print more money, it goes negative. It creates negative GDP. And that has occurred in the last couple of years, where the more that they printed since the pandemic, it actually led to either a decrease in GDP or a slowing in the acceleration of GDP. So we're past the point of printing easy fiat money and having that do anything. And what's causing that is a pop in precious metals. You're starting to see a pop in silver, and this is monetary demand, just like silver streets, monetary demand. This is the industrial part of the chart. This is the industrial part of the chart. When you have straight up like this is monetary demand. Pandemic crisis, banking crisis, okay? Gold is more of a long-term barometer, where silver is the yappy dog and the short-term indicator, which is a favorite of stackers. I know silver can go big and people like it, but your real long-term indicator is gold. Boom, look at that trend line. And lately we popped through very hard short-term resistance, and we very likely touched on a new all-time high. Can we call that a new all-time high? People really aren't, because it was just like a candle, the tip of a candle on a technical chart. So technically you can't say that that is a substantive new high in gold, but essentially we're going there. That's what you see in the charts. Why? Because of what's been happening. And now what we have lining up is two choices, ladies and gentlemen. You have the red pill and the blue pill. Okay, one pill puts you back inside the matrix and the central bank digital currencies and the social credit system, okay, and the stealing of your labor. The other pill leads you to gold, silver, maybe private cryptos, maybe other things, maybe even seashells at some point, that get you value outside, barter, that get you value outside the system. I prefer gold, silver, asset-backed digital currencies like Kinesis, Load, RS, or any state issue asset-backed digital currency, as long as it's audited, we know. Okay, and we know that they're not screwing it up. And now state-backed meaning not federal government, but like state of Texas, state of Utah, something like that. maybe looking at private digital cryptos if you think Bitcoin, Ethereum, or way. And for me, Bitcoin, Ethereum is a way to transact, not necessarily to hold value. So if I needed to transact, and I could in those, and the banking system is having problems, I could go that way, or I could go to Kinesis or Load and do it that way. But Bitcoin, Ethereum's not where I'm holding value. I'm going to do it in gold and silver. That's my personal. I'm not your financial advisor. You should do what you want. But again, those are the alternatives. And we need to start talking about that as a society. We need to have a public conversation, because a lot of people don't know this is coming. 318 of you sitting or in here right now watching this, you know what's coming. And if you've been following my program, you know what's coming. And we're approaching, I think it's 4 million views, or maybe we pop 4 million views. So at some point, a lot of people have seen our stuff. But that's a drop in the bucket to the 8 billion people, almost 8 billion people in the world. Okay, so we got to spread the word more, and that's you. You're the army, guys. You're the honest money army. You're the digital army. You're the physical army. You're the whole army, okay? And it's you guys that we depend upon, and we thank you guys for joining the channel and spreading that word. By the way, a special thanks to Peter Frohwein for riding shotgun and being a channel moderator. I do owe Peter something, which I have, and I'm going to get, when I see Ian next week, I'm going to get an extra Silver is Freedom bar. This bar was minted by Silverback Precious Metals. It is the Gold Silver Pros channel official bar. You can only get it here. There were only 90 made. There are only about 30 left. One of those goes to Mr. Peter Frohwein. This is number 1, goes to me, as you can see etched on the back. These are available, and the only place you can get it is Arc Silver, and there's only one way at Arc Silver to do it. I'm going to show you that and do a little bit of advertisement for Precious Metals while we're here, guys, because it does help the channel, and I really do want to help you get silver and gold as cheaply as possible. So if you want precious metals, go down here to where it says Arc Silver. This is where you get your physical at the cheapest price we can find it, the lowest premium, the lowest markup. You can get these bars, Silver is Freedom bars, the official bar of Gold Silver Pros channel, designed by our social media extraordinaire, Danny, who does such a great job and does wonderful stuff for us across social media. You can get that. You can also get other things. To do it, you click on Access Deals and fill out the form, and we'll boot up the new store here in a moment. In any case, if you're interested, sign that form. It goes to Ian. Ian gets it. He'll either text or email you back or call you. That detail is on the form. You can call him directly if you don't want to use the form. If you're the type of person like, I don't want to use the form, I don't want anything electronic going across the internet that identifies me across email because it's an email form, call the number or just email straight from your account to that Arc Silver mailbox. Now, he's got other things going on. We'll have him back on the program next week to talk about his deals. But if you're wanting silver, he's got these. These are Canadian maple leafs. You can get those at arcsilver.com. And I guarantee you, any sovereign coin that he has in stock, he will beat the average premium of the big boys. And if he doesn't, then that means, you know, you win. But 99 times out of 100, I've seen him beat it. And we'll talk to him next week about what his premiums are. Call him and ask. You know, they move every single day, 10 times a day. But he tends to give the lowest premiums, especially on silver. This is a 10-ounce Royal Canadian bar, which Mr. Ian has as well. And if you want to get really fun and you want to do bar slices, we've got the ones that Jim at Forsyth Engineering Silverback Precious Metals does. This is the Silver Ape Silverback. And this is the bar that I bought off of the COMEX that Ian had delivered that I then sent to Jim, and he cut it up. And this is, I think, a 25-ounce slice. Yeah, and it's got my name and serial bar on it. If you want to get those from Silverback Precious Metals, cut right off of a COMEX bar. We took it off the industrial exchange and said, thank you very much. We're going to democratize industrial metal and get it in the hands of people. You get it through Arc Silver, the only place you're probably going to get it. I think there's 1 or 2 other places online, but Jim does those for Ian, and you can get it at Arc Silver. That's our advertisement for the day, guys. Thanks for sticking through that. We appreciate it. We appreciate you being a part of the channel. We appreciate you being here and voting in the poll. Thank you so much for joining. This has been Rob Keene's Gold Silver Pros Cowboy Metals Live Special Thursday afternoon edition, 4:45 p.m. now on March 4, 2023. To date it, I'm your host, Rob Keenes, the one and only. And we're on YouTube, Twitter. If you see us on Telegram, that ain't us, or on Discus or on Discord. We don't use those. You got to come here. Thanks so much, guys, for joining the program. Stay on the channel. We've got so much content. It's ridiculous. If you want to know about central bank digital currencies, we got a playlist. If you want to know about gold and silver, we got a playlist. If you want to know about problems with the Perth Mint, we got a playlist. If you want to know anything having to do with macroeconomics and gold and silver, we got a playlist or a video. Stick here on the channel. We'll teach you. We're your free university where we bring you together. Now, one last thing, ladies and gentlemen, one last thing before you leave. Super important. We are booting up a new community. I just said we're on YouTube and Twitter and a little bit on TikTok and Rumble and those things. But we're booting up a new community on a popular message board platform, and you guys are going to get to see it. It's actually technically out, and I'm going to officially announce it next week. I'm just a part of that community. I don't own it, but I wanted to be a part of it because it's about sound money, and it's about bringing the sound money community together. Not only stackers, but others as well that have a common interest. That's coming out next week. It'll be the only forum of its kind. I think you guys will really enjoy it, and we made it for you. We made it for you because we all need to band together. We need to educate each other, and we need to edify each other in a way in which we operate with high integrity and trust and communication and transparency. And we haven't seen that as much in this end of the community. So we're creating a solution to that for you. And I promise you, it's going to be super fucking awesome. Thank you guys for joining the channel. This is going to do it for today's edition of Cowboy Metals Live. Stay tuned to the channel. On Fridays, we do the weekly market wrap. You don't want to miss that. That's where we go over economic data. That's where we go over what's going on in gold and silver. We show you the COT report. We tell you everything that's going on there. You'll, at that 12 to 15-minute presentation, you'll have everything you need to know every week to know exactly where the economy is and exactly where it's going and exactly where the precious metals are going. I'm the only one that does it. You have to get it on this channel, or you can go to JM Bullion's YouTube channel and you'll see it there too, because we do that content for JM Bullion as well. All right, that's going to do it. Thank you so much for joining Gold Silver Pros. We're bigger, we're stronger, we're meaner, and we're growing, and we're bringing more services to you in the community. Thank you so much for being a part of it. Next time, Rob Kientz, Gold Silver Pros.